U.S. President Biden and Republican lawmakers are meeting in person this afternoon to lay out their arguments for raising the $31.4 trillion U.S. debt ceiling. Nerves are running high, of course, because if the matter isn't resolved by June 1st or shortly thereafter, the U.S. could default on its payments, which would have serious implications for the U.S. economy. Our next guest says the risk of a default is higher than it's ever been in past debt ceiling debates. Let's bring in Charles Meyer, chairman and founder of Signum Global, where your job, Charles, is to take what's happening in the political realm and talk about the risks it means for investors. And it seems like, based on your notes to clients, you're more worried than you've ever been when it comes to the debt ceiling. Why?
Yeah, we're more concerned than ever because the two sides, the Democrats and the Republicans, are much more dug in. We also have a more extreme group of Republicans in the Freedom Caucus today than we did in 2011, the last time this became very acute in the markets. The debt ceiling became acute in the markets. The other difference is that Speaker McCarthy only has a 5-seat majority in the House, whereas back in 11, Speaker Boehner had a much bigger majority. So the political room for maneuvering is much narrower than it has been in modern history. And we this morning raised our probability that we go over the X date from 10% to 25%. And relatedly, if I can just quickly to say, I think the markets are mispricing risk at this point. The X date is possibly early June. And if you remember in 2011, the U.S. equity markets sold off 17% from mid-July into August, which was the debt ceiling crisis, and then it culminated after the resolution with the downgrade of the sovereign by S&P. That total downside move was 17%. The markets today are not discounting any negative outcome, with the exception of CDS.
Are you warning that we could be in for a significant drop compared to where we are right now on that scale, or perhaps even bigger?
Yeah, I think that, the meeting, as you referenced earlier, at the White House today at 4 p.m. is very important, although we don't expect anything major to come out of it. At least the two sides are talking. That's a good thing. But as we hurtle towards the X date, I think that the markets are going to have to start pricing in the possibility that we go over for the first time. So at the best case scenario over the next month and possibly month and a half is we hit a major pocket of volatility. I think the more likely scenario is volatility with quite a bit of downside. I think people are really not prepared. There's a lot of complacency in the market. You hear really seasoned investors say, we've been here before, it will get resolved. That's very likely to happen, but I think the risk that we go over is higher than ever.
You have to prepare investors for what happens if we do go over, and in some ways that's unprecedented territory. How do you think about the knock-on effects of doing that, even though it's still like a relatively lower probability?
Yeah, look, I think if you're a long-term investor, you really can't change your investing, your strategy based around the debt ceiling. But for shorter-term investors, I would absolutely be going long volatility. I'd be shorting to the extent I can, or buying protection on the downside. Where we are seeing the market, markets discounting at least some possibly negative outcome is in the CDS spreads. The CDS market is not very liquid, but CDS spreads have really spiked in anticipation of this. But overall, I'd be a little more defensive in the short term and certainly try to buy some downside protection.
Who's got the power in the negotiations right now? President Biden's popularity is very low. Might that pressure him to allow for greater concessions?
Yeah, I think so. Both sides, again, are very dug in. But as we get closer and closer to the X date, and Secretary Yellen recently, just last week, revised the X date or reaffirmed the X date early June, possibly as early as June 1. But in the next week or two, she'll need to revise even further that X date. Once we know with more clarity from her on when the X date is, which I think still is early to mid-June, then, the brinkmanship on both sides politically has to come to some kind of resolution. I think the White House will probably have to blink and agree to some spending cuts, and we get a last-minute debt ceiling bill to lift the ceiling. But again, I just want to highlight or caution that we may actually go over the X date for the first time. It is very possible this time.
And will that automatically mean downgrades, do you think?
So the rating agencies are very important in this. You raise a great point. Fitch have already come out to say in writing that if we go over the X date and Treasury starts to prioritize payments, that would not be consistent with a AAA rated country, implying a downgrade. If in a worst case scenario, Treasury ultimately starts defaulting on treasuries, which is different. They're going to do everything they can, even in prioritization, to avoid that scenario. But if they do, then Fitch has said it would trigger a downgrade of the sovereign to a default rating. So the rating agencies, I think, are going to be very important. My S&P's already downgraded us, and 11 haven't upgraded us. It'll be interesting to see what Fitch and Moody's do as we get closer to the X date, or worse, go over.
Where is the conversation around minting $1 trillion coin to kind of use a trick to get out of this? People talk about it, but politically, is it palatable? Does it have any legs at all?
So there are several workarounds that keep getting, whenever we get into this situation, get thrown around and actually considered seriously. The $1 trillion coin is very unlikely. I would argue almost impossible. Fed and Treasury both said it's just not viable. I think it would be like printing money on steroids, frankly, and it would undermine confidence in the U.S. economy, the dollar, and our markets. So I would rule that out. Secondly, the discharge petition is a possibility. The Democrats are going to try that. We'll see if it works. We're very skeptical given the time frame involved. And third, the president possibly using the 14th Amendment or executive authority to lift the ceiling. I don't expect him to do that proactively, but he could after we go through the X date. And if we're really facing a major default on treasuries, I do think the president would use the 14th Amendment to lift the ceiling, and then we're in a constitutional crisis. That's not a great outcome either. So the only real solution is for Congress to lift the ceiling with the debt ceiling bill.